Hi, my name is Alex Carlucci with Gustan Show Associates. I want to talk to you about ARMs and how ARMs are really no good right now, but in the future they may be. So let's explain how ARMs work. There's 3, 5, 7, 10-year ARMs. In general, those are the ARMs that we do. And what that means is that your loan's fixed for 3 years at the rate that we give you. And it's usually a much lower rate than 30-year fixed, but right now it's not. I'm going to get to that in a second. The 5-year ARM means it's fixed for 5 years, and then the 7 is fixed for 7 years, and the 10-year ARM is fixed for 10 years. What happens to those ARMs after those time periods are up is they adjust at a certain amount, usually 2%, up to 2%. So if rates would have gone up huge in those 3 years, and now you're forced to refinance, and the rates are much higher, and you don't refinance, your 3-year ARM 4% rate might get adjusted up to as much as 6% after that 3-year period, only if the going rate went up by 2 percentage points. They don't just jack it up 2 points on you because they can. They follow what's called a LIBOR usually. So if the LIBOR rate goes up by 2 percentage points, your 3-year ARM rate will now adjust by 2 points. So it'll adjust whatever the market's done over that 3-year period. And if it's gone down, then it'll adjust down. So you don't have to refinance, but you can refinance into a fixed after the ARM's up or before the ARM's up. If you wait till after the ARM's up and your rate goes up, your rate's going to go up. Now, usually it caps out at 6% over the life. So if rates go to 30% on your 3-year ARM, it'll go up 2% per every 2 years necessarily with a 6% cap. So after the first adjustment period, after 3-year ARM, it'll go up 2 percentage points, and then after 5 years, that's another 2 years, it'll go up to another 2 points, and then after 7 years, it'll go up another 2 points. It won't go up anymore. There's a cap. It's a 6% cap usually on these ARMs. So if you start at 4, and let's say rates went up to 30%, your max rate will be 10% over the life of that loan, and it won't happen until 3 adjustment periods of 2% cap. So it's called a 222 or whatever, 223. I don't know what they call it. But anyway, that's how it works. And if you got any questions on that, you can give me a call. But now, when it comes to ARMs not being so much better than the 30-year fixes, because the yield curve right now is called a flat yield curve. What that means is that the front end of the rates is pretty similar to the back end. And if you look at like a 2-year note on the CNBC, it's like 2%. You look at the 5-year note, it's like 2.5. And you look at the 30-year, it's like 2%. So they're all like around 2%. So there's no benefit in doing an ARM right now because the short end is equal to the back end. There's no benefit. So back in the days when ARMs were really good, you'd see a 30-year note at 10%, and you'd see a 2-year note at 2%, and that's when you'd see a huge savings in ARM. So you know the 30-year fix might have been 8% back then, and a 3-year ARM might have been 3%. So you're like, oh, I'm doing the ARM. I'm not going to be there more than 3 years. I'll probably sell this house, or I'm going to take advantage of it. I don't think rates are going anywhere. So people did a lot of ARMs then because it was such a huge savings. Right now it's flat. There's no savings, so there's no real reason to do an ARM. And when it comes to ARMs, they qualify you with a 2% higher than the 3-year and 5-year ARMs. So if you get a 3-year ARM at a 3%, and they're going to qualify you at that payment at 5%. So there's no reason to do a 3 or 5-year ARM. Now the 7-year ARM, they'll qualify you at the rate, and the 10-year ARM, they'll qualify you at the rate. So if you don't qualify for a mortgage on a 30-year fix and the 10-year ARM is an eighth lower, then maybe you do the 10-year ARM for that reason, but that's the only reason why I see doing ARMs right now. That's basically the skinny on ARMs. If you got any questions, give me a call, 630-915-7550. Go to GustanShow.com. Thank you.